Hello everyone, welcome to the 90th episode of me learning how to trade in Forex. So in the last video we went through the how to create your own commitment of traders trading indicator. So 2 steps: decide how long of a period we want to cover, calculate the difference between the positions of large speculators and commercial traders for each week, with the formula being difference is net position of large speculators minus net position of commercials. And then rank the results in ascending order from most negative to most positive. Assign a value of 100 to the largest and 0 to the smallest. And now you can see like whether the value is an extreme, such as 0 or 100. And yeah, now we are on how to interpret the traders report. So let's get interpret the commitment of traders report 30th. So how to interpret the commitment of traders report. Now that we know how to determine sentiment extremes, what's next? Recall that not every sentiment extreme results in a market top or bottom, so we'll need a more accurate indicator. Not every sentiment extreme results in the market top or bottom, yep. Calculating the percentage of speculative positions that are long or short would be a better gauge to see whether the market is topping or bottoming out. Percentage of speculative positions at long or short. The equation to calculate the percentage of long and percentage of short is indicated below. Percentage of long equals number of long contracts over number of long contracts plus number of short contracts. Percentage short equals number of short contracts over percentage of number of long contracts plus number of short contracts. To illustrate this better, let's go back a few years and see what happened with the Canadian dollar futures. Going through the commitment of traders reports released on the week ending August the 22nd, 2008, speculators were net short 28,085 contracts. On March 20th, 2009, they were net short 23,950 contracts. From this information alone, you would say that there is a higher probability of a market bottom in August, since there are more speculators that were short in that period. But hold on a minute there, you didn't think it would be that easy, right? A closer look would show that 66,726 contracts were short, whilst 38,641 contracts were long. Out of all the speculative positions in August, 63.3% were short positions. On the other hand, there were just 8,715 long contracts and 32,665 short contracts in March. This means that 78.9% of the speculative positions were short positions during that period. What does this mean? There is a higher chance that a bottom will occur when 78.9% of all speculative positions are short, as opposed to just 73.3%. So, not quite bottom A. Net short positions equals net short positions is 28,085. Percentage of short ratio is 63.3%. Net short positions 23,950. Short ratio is 78.9%, the true market bottom over here. Right, okay, so calculating the percentage of speculative positions that are long or short would be a better gauge to see whether the market is topping or bottoming out. The equation to calculate for the percentage long and short is indicated below. So percentage of long is equal to number of long trades divided by number of long contracts minus number of short contracts. Percentage of short is equal to number of short. Why do I write traders here? Contracts divided by. Wait, this is plus, not minus. Whoops. Number of long contracts plus number of short contracts. As you can see on the chart above, the bottom in fact did not occur around August 2008, when the Canadian dollar was worth roughly around 94 US cents. The Canadian dollar continued to fall over the next few months. By the time March came around and percentage short ratio hit 79.9%, the Canadian dollar had hit a bottom around 77 US cents. Then what happened? It started steadily rise. A market bottom? Yep, you got it. Right. Summary, market sentiment. Market sentiment. Did those 1,000 pips moves excite you? Before we start betting the farm based on our analysis of the commitment of traders reports, remember that those were just specific cases of when the commitment of traders reports signaled a perfect market reversal. The best thing to do would be to backtest and look at the reasons why a reversal took place. Was the economy booming, or was it in the middle of the recession? Remember, the commitment of traders report measures the sentiment of traders during a specific period of time. Like every other tool in your toolbox, using the commitment of traders report as an indicator does not always correlate to market reversals. Traders report measures the market sentiment of traders during a specific time. Period of time. Period of time. So take the time to study this report and get your own feel of what works and what doesn't. Also, before we bring this lesson to an end, always keep in mind that market prices aren't driven solely by COT reports, stochastics, Fibonacci levels, etc. The markets are driven by the millions of people reacting to economic analysis, fundamental reports, politics, Godzilla attacks, UFO sightings, Lady Gaga concerts, life in general. It is how you use these tools that will help you be prepared for what lies ahead. In conclusion, as a Forex trader, it is our job to gauge what the market is feeling. Trader, it's our job to gauge what the market is feeling. One way to gauge market sentiment extremes is through the commitment of traders reports. By understanding the activities of the three groups of traders, commercial traders, non-commercial retail traders, we can find ourselves in better positions to fish for tops and bottoms. Remember, every market top or bottom is accompanied by a sentiment extreme, but not every sentiment extreme results in a market top or bottom. Every market top or bottom is accompanied by a sentiment extreme, but not every sentiment extreme results in a market top or bottom. Quiz time. Market sentiment. The market has feelings too, you know. Do you know the tools to read its feelings, like the Commitment of Traders report, and how to time a trade? Let's see what you got. Which of the three groups are most bullish at market bottoms and most bearish at market tops? Most bullish. Large speculators. Oh no. The combination of all views, ideas and opinions of the participants in the market are known as market sentiment. It will be best to combine market sentiment analysis with something and something analysis. Technical and fundamental analysis. Which of the three groups is most likely to sell on a downtrend and keep adding to their position until reversal is in place? Small speculators. Oh no. What does the Commitment of Traders report? Commitment of Traders. Who releases the Commitment of Traders report? CFTC. In the Commitment of Traders reports, this group refers to big businesses that use currency future contracts to hedge against exchange rate fluctuations. Commercial. When using the Commitment of Traders report, under which exchange should you look for currency futures? Chicago Mercantile Exchange. Using the Commitment Traders report is most useful when trying to spot a reversal. If commercial positioning signals a reversal, speculative position indicates. If commercial signals reversal, speculative position it's one of the top two, indicates a reversal. A market top or bottom? Oh no, it's the other one. When speculatives are at extreme short levels, when speculators are at extreme short levels, chances are that the market is likely near the bottom. What is the formula needed to create your own COT indicator? Difference is net position of large is minus commercials minus large speculators. Nope. What is the formula to get the percentage of speculative positions that are short? Short contracts, long plus short. Yeah, that one. Right, okay, so what happened? It's kind of awful actually. Wait, let me just redo that one. Can I redo that one? Let's see. Which are most bearish at market caps, tops? Hedges. The combination of view, market sentiment, technical fundamental. This is large speculators. Commitment of Traders. Who is CFTC? Commercial. Using under which exchange? Chicago Mercantile. When trying to spot a reversal. Speculative changes trend direction. Near the bottom. Difference is net position of large minus commercials. Number of shorts. There we go. Okay, that's better. Right. Next course, which is what news makes the Forex market move. So News makes the Forex market move. 30th. It's not enough to only know technical analysis when you trade. It's just as important to know what makes the Forex market move. Just like in the Great Star Wars Wars, behind the trend lines, double tops, and head and shoulder patterns, there is a fundamental force behind these movements. This force is called the news. To understand the importance of the news, imagine this scenario, purely fictional of course. Let's say on your nightly news there is a report that the biggest software company just filed bankruptcy. You own shares of this company. What is the first thing you would do? How would your perception of this company change? How do you think other people's perception of this company would change? The obvious reaction would be that you would immediately sell off your shares. In fact, this is probably what just about everyone else who had any stake in that company would do. The fact is that news affects the way we perceive and act on our trading decisions. News affects the way we perceive and act on our trading decisions. It's no different when it comes to trading currencies. There is, however, a distinct difference between how news is handled in the stock market and the forex market. Let's go back to our examples above. I imagine that you heard that the same report of the big software company filing bankruptcy, but let's say that you heard the report a day before it was actually announced in the news. Naturally, you would sell off all your shares, and as a result of you hearing the news a day earlier, you would save more money than everyone else who heard it on their nightly news. Sounds good for you, right? Unfortunately, this little trick is called insider trading, and it would have you thrown in jail. Oof. Martha Stewart did it, and now she has a nice mugshot to go along with her magazine covers. Oof. In the stock market, when you hear news before everyone else, it is illegal. In the forex market, it's called fair game. Right, okay. The earlier you see or hear the news, the better it is for your trading, and there is absolutely no penalty for it. Right. No penalty for seeing and hearing the news early before everyone else. No penalty. There we go. The better it is, and there is absolutely no penalty for it. Add on some technology and the power of instant communication, and what you have is the latest and greatest, or not so greatest, news at the tip of your fingers. This is great news for retail traders because it allows the US to react fairly quickly to the market speculations. Big traders, small traders, hussy traders, or skinny traders all have to depend on the same news to make the market move, because if there wasn't any news, the market would hardly move at all. The news is important to the forex market because it's the news that makes it move. Regardless of the technicals, the news is the fuel that keeps the forex market going. Right. Beginner's Guide to Forex News Trading. As forex traders, it's important to pay attention to major economic data releases, speeches from government officials, and geopolitical events. Why? Because this information usually reflects the strength of a given currency and may indicate the future direction of a given currency. Trading the news is often difficult and not be suitable for everyone, but the volatility that follows can create lots of trading opportunities. Why trade the news? The simple answer to that question is to make more money. But in all seriousness, as we learned in the previous lesson, the news is a very important part of the forex market because the news has the potential to make the market move. When news comes out, especially important news that everyone is watching, you can almost expect to see some major movements. The fact that you know the market will most likely move somewhere makes it an opportunity definitely worth looking at. Your goal then as a news trader is to get on the correct side of the new move. The dangers of trading the news. As with any trading strategy, there are always possible dangers that you could be aware of. You should be aware of. Here are some of those dangers. Spreads widen. Because the Forex market is very volatile during important news events, many Forex brokers widen the spread during these times. Trading the news can contain some dangers. Spread dangers. Spread widen. Because the many Forex brokers widen the spread during important news events. Normal spreads 2 pips, so 60 minus 58, that's 2. Wide spreads 68 minus 48, that's 20 pips. WTF? This increases trading costs and can hurt your bottom line. This increases trading costs. You could also get locked out, which means that your trade could be executed at the right time but may not show up on your trading platform for a few minutes. This is bad for you because you won't be able to make any adjustments if the trade moves against you. Could also get locked out, meaning trade could be executed at the right time but may not show up on the trading platform for a few minutes. This is bad for you because you won't be able to make any adjustments if the trade moves against you. Therefore, adjustments can't be made if the trade moves against you. Imagine thinking you didn't get triggered, so you try to enter the market price at the market price, only to realize the original order got triggered. You'd be risking twice as much now. Price slippage. You could also experience slippage. Price slippage. Slippage occurs when you wish to enter the market at a certain price, but due to the extreme volatility during these events, you actually get filed at a far different price. Slippage occurs when you wish to enter the market at a certain price, but due to the extreme volatility, you actually get filed at a far different price. But price gaps a lot. Your order is filed at the next available price. You place a sell order at this low. Slippage. Price is filled here when it's opened. Big market moves made by news events often don't move in one direction. Oftentimes the market may start flying in one direction only to be whipsawed back into the other direction. Trying to find the right direction can sometimes be a headache. Profitable as it may be, trading news isn't as easy as beating some toddler at Fortnite. It will take tons of practice, and you guessed it, more practice. Most importantly, you must always have a plan in place. In the following lessons, we'll give you some tips on how to safely trade the news. How to trade Forex on news releases. Before developing a trade the news strategy, we have to look at which news events are even worth trading. You want to be able to answer which news releases should I trade. Decide which news events are worth trading. Forex traders should familiarize themselves with the key event risks that heavily impact the major currencies. Traders should familiarize themselves with the key event risks that heavily impact the major currencies. Key event risks that heavily impact the major currencies. Remember that we're trading the news because of its ability to increase volatility in the short term. So naturally we'll like to only trade news that has the best market moving potential for the currency market. The news that tends to drive price action and produce volatility usually involves news which tends to drive price action and produce volatility usually involves changes in the central bank policy, monetary policy, shifts in government policy, shifts in government policy, fiscal policy, unexpected results in economic data releases, random tweets from a certain world leader who likes to put his name on tall buildings. Okay. Random tweets from a certain world leader who likes to put his name on tall buildings. Being aware of the upcoming key event risks can help avoid being on the wrong side of the market. Aware of upcoming key event risks can help avoid being on the wrong side of the market. How to find events that produce volatility. The babypips.com economic calendar highlights the important events and economic data that are being released by the countries with the most popularly traded currencies. The number of events scheduled can reach over 100 at any given week. Trying to sift through so many events can be a pain in the butt. Luckily for you, our economic calendar makes it easy to identify the relative importance of each specific event. In our economic calendar, you have the ability to filter event listings by impact. For example, by selecting only high, the economic calendar will only display the events that have historically been known to produce market volatility. If you spend some time exploring the economic calendar, you'll start to notice that the most important events usually relates to change in interest rates, inflation, and economic growth, like retail sales, manufacturing, and consumer sentiment. Here are some examples. Most important produce market volatility events which historically has been caused market volatility. Most important events which historically caused market volatility include interest rate decisions by central banks. Interest rate decisions by central banks. Inflation, CPI, PCE, PPI, employment data, unemployment, wage growth, economic growth, GDP, retail sales, industrial production, business sentiment surveys, manufacturing sector surveys, consumer confidence surveys, housing data, sales, construction, trade balance. Different countries may use different names for similar data, but we try to point that out in the economic calendar. Depending on what's currently happening in the world, the relative importance of this event may change. For example, interest rate decisions may be the main focus during a certain time, whilst during a different time it will seem like nobody cares. This is why it's important to stay informed and know what the market is focusing on at the moment. Right. Depending on what's happening in the world, the relative importance of the events may change, i.e. interest rate decisions may be the main focus during a certain time, while during a different time it will seem like nobody cares. This is why it's important to stay informed and know what the market is focusing on at the moment. It's important to stay informed and know what the market is focusing on at the moment. Pay special attention to news from the US. While the market reacts to most economic news from various countries, the biggest movers and most watched news come from the US. The United States is still considered the world's most powerful country, whether it's the domain of military affairs, geopolitics, industry, energy, science, culture, and technology. It is even described as a financial superpower. Even if its position has been eroded by setbacks, imbalances and weaknesses, the strength and influence of the US dollar will not be matched anytime soon. The United States still has the largest economy in the world, and the US dollar is the world's reserve currency. This means that the US dollar is a participant in about 90% of all Forex transactions, which makes US news and data important to watch. And news is important to watch. With that said, let's take a look at some of the most volatile news for the US. Most volatile news reports: average pips moved, NFP, FOMC, fear of missing out, trade balance, CPI, retail sales. In addition to inflation reports and central bank speeches, you should also pay attention to geopolitical news, such as pandemics, wars, natural disasters, political unrest and protest, upcoming elections. Wait, is this related to any of the sections down here? We should probably make our own little graph here instead of relying on the this. So in addition to inflation reports and central bank speeches, geopolitical news such as pandemics, wars, natural disasters, political unrest and protests, upcoming elections. Pay attention to. Although these may not have as a big an impact as the other news, it's still worth paying attention to them. When our economic nerd Pippo is in a good mood, he usually releases an article on the upcoming news reports that you can play, and with trade strategies to boot. Also keep an eye on moves in the stock market, especially the US stock market. Right. Watch the US stock market. There are times when sentiment in the equity market will be the precursor to the major moves in the currency markets. There are times when sentiment in the equity markets will be the precursor to major moves in the currency markets. There will be times, or there are times, when sentiment in the equity markets will be the precursor to major moves in the currency market. There are times when sentiment in the equity markets will be the precursor to the major moves in the currency market. There are times when sentiment in the equity markets will be the precursor to major moves in the currency market. Now that we know which news events make the most moves, our next step is to determine which currency pair are worth trading. How to choose currency pairs to trade the news. After identifying the event to monitor, you now want to trade the currency associated with that event's economy. Define the event to monitor. Trade the currency associated with that event's economy. Choosing the appropriate currency pair is an important decision when trading the news. As a news trader, you're trying to achieve two things: take advantage of the short-term spike in volatility while keeping your transaction costs as low as possible. as a news trader, take advantage of the short-term volatility and short-term spike in volatility and keep the transaction costs as low as possible. Because news can bring increased volatility in the Forex market and more trading opportunities, it is important that we trade currencies that are deeply liquid. Important to trade currencies that are deeply liquid. Currencies with deep liquidity have the tightest spreads, which are what allow you to keep your transaction low. Currencies with deep liquidity have the tightest spreads, which keeps the transaction costs low. Liquid currency pairs can give us reassurance that our orders will be executed smoothly and without any hiccups. Euro USD, GBP USD, USD JPY, USD CHF, USD CAD, and AUD USD. Right, liquid currency pairs gives reassurance that the orders will be executed smoothly. Currency pairs gives assurance that the orders will be executed smoothly. Did you notice anything here? That's right, they're all major currency pairs. Liquid currency pairs. What's it? Liquid, i.e. major currency pairs. Currency pairs. Remember, because they have the most liquidity, major pairs usually have the tightest spreads. Since spreads widen when the news reports comes out, it makes sense to stick with those pairs that have the tightest spreads to begin with. Spreads widen when news comes out. Now that we know which news events and currency pairs to trade, let's take a look at some approaches to trading the news. Right. I think we've got everything in that. Special attention to news from the US. Watch the stock market, especially the US stock market. The goal is to take advantage of the short term and keep the transactions as low as possible. As news can bring increased volatility in the Forex market. Major currency pairs Okay, cool. That's all done. In the next video, we're going to carry on with trading the news section with 2 ways to trade the news. So thank you all for watching, and I will see you in the next video. Goodbye.